Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Franklin Templeton's Rising Rates Defensive Portfolio. Now, as per its name, we would expect this portfolio to be defensive and also to protect or mitigate against rising interest rates. So let's investigate that. And we're going to kick off with a holdings analysis in the sense of what funds are included in this portfolio. Now, we can see there's about, I think, 16 mutual funds and ETFs and cash in this portfolio. Half of them are associated with Franklin or affiliates of Franklin, like Putnam and Brandywine. And these funds also do tend to be expensive ones. So, for example, you can see the short duration fund is charging 37 basis points, which is a lot for a short-term bond fund. Now, without going too in depth here, I can already tell that having 16 funds is not necessary. You can consolidate most of those. For example, there's a short duration fund, then there is a 1 to 3 year treasury bond, there's investment grade corporate bonds, and so on. Right? But we'll get to that later on. With regards to benchmarking this portfolio, we can see that the auto-suggested benchmark from our platform is a global 40s equities and 60 bonds portfolio. And we can see that the portfolio from Franklin Templeton has outperformed this portfolio since 2022. And recall that 2022 is when interest rates started rising. Now, it is worth mentioning that this is the performance of the current portfolio. This is not the actual track record of this portfolio. However, we can look at that on the fact sheet. And here we can see that the performance of the benchmark that Franklin determined was effectively 4.18% since inception in 2021 versus the net performance of the portfolio was 1.33. Stated differently, the track record highlights that this portfolio has significantly underperformed the benchmark defined by Franklin Templeton itself. Now, going back to our benchmark and our analysis, let's have a quick look in terms of from an asset class, in terms of what we can see that's in this portfolio, right? They have 16 funds. This makes it rather complicated to get a snapshot. And what we can see over here, that from a holding space perspective, it's 55 or 50% fixed income and 45% equities. Kind of what you would assume from a defensive portfolio. Having said that, from a risk-based perspective, we can see it's 75% equities. And we can simply reconcile these two different perspectives that a lot of bond funds, for example, like high yield, which this portfolio contains, are actually highly correlated equities and are not very defensive at all. Now, this is with regards to in terms of how this portfolio is comprised of. Next, let's move on to risk. And what we can look over here is kind of a simple drawdown analysis and stress testing. Now we can see the drawdowns of this portfolio, right, of the current holdings from, 2022 today, compared to this benchmark portfolio that we have defined of global equities and, like investment grade bonds, like 40/60. Now, here we actually do see that this portfolio has been more defensive, right? So we can see in 2022, it declined slightly less, which makes sense because this portfolio does not only include bonds, but also bonds that slightly benefit from rising interest rates, like floating rate debt and TIPS. Now, so this is kind of interesting, right? And that gives us the impression that this is more defensive, right, than kind of like this benchmark portfolio. Having said that, it's only also a short amount of time. Now we can use, we can basically extend the track record by using a replication portfolio. And that allows us to see how this portfolio would have performed going back, all the way to 2004. And what's kind of interesting to see is that actually this portfolio would have underperformed in 2009 and most of the periods thereafter. So stated differently, this portfolio has been defensive, but only in a kind of like rising interest rates environment, not overall. And that's an important distinction. We can dig further into how much this portfolio protects against rising interest rates. And here, for example, we can see the correlation to the US 10-year bond yield. Now, compared to the benchmark portfolios of investment grade bonds and equities, indeed Franklin Templeton's portfolio benefits was less highly correlated to falling yields. However, as we can see, that blue dot is still in the lower left quadrant, right? And so it is still positively correlated with falling yields, not with rising yields. And we can simply explain this, that what Franklin is trying to achieve is this trade-off between being defensive and mitigating rising interest rates. But there's a trade-off there. And so there are some instruments in here in Franklin's portfolio, like TIPS and floating rates that benefit from rising interest rates. They only account about 8%. About 40% is traditional fixed income, like short-term treasuries, short-term bonds, investment grade bonds, that all benefit from falling rates and rising rates. So overall, is this a portfolio, right, that is defensive? Yes, it is, right? But it's certainly not one, right, that outperforms strongly when rising rate goes up. It suffers as this benchmark portfolio. So this is with regards to its nature. The other question that is interesting to ask is, can we reduce fees? So as mentioned, this portfolio contains some very expensive mutual funds from the Franklin Templeton family, right? And we can effectively replace those with cheaper ETFs, right? Those ones that track benchmark indices. So for example, we can see, this is a good example over here. We can see here is this ClearBridge large growth ETF, right? That charges 73 basis points. And we can simply replace this with a product from Vanguard, which is the Russell 1000 Growth Index, that charges 8 basis points. And if we do this for the entire portfolio, we can reduce the fees from 36 basis points to 6 basis points. And as you can see on the right-hand side, this is without really impairing the performance. The final question that we asked ourselves is, it's a very complex portfolio. Can we simplify it? And short answer is yes, we can. So we created a simple portfolio that includes global equities, where we've taken URTH, the MSCI World. We have taken AGG for US investment grades, and we have taken allocation to FLOT, which is floating rates. And as you can see, right, that performance is almost identical, right? And now we have 3 securities versus 16 plus cash. It is worth mentioning that the portfolio from Franklin Templeton has a slightly higher Sharpe ratio than the replication portfolio, but also that the replication portfolio is slightly less correlated to bonds, which makes it more attractive or more mitigating when interest rates rise. And so this kind of concludes our short analysis of Franklin Templeton's rising rates defensive portfolio. Overall, we do see that this portfolio is unnecessarily complex. There is no need to have 16 holdings plus cash. You can basically replicate this with 3 securities, and you can also reduce the cost from 36 basis points to 6 or 8 basis points. Hope that helps. Have a nice day.